Hi, welcome to this podcast where I'm going to be looking at share issues, and particularly where the shares are sold so that they can be paid for by the person buying them in installments. Okay, a couple of terms that you may have heard. IPO, which is initial public offering, and that's done the first time that a business lists itself on a stock exchange where it allows the general public to start buying shares. If it then were to offer more shares up to the authorised share capital, then that would be a follow-on public offering. Okay, a couple of terms that we're going to use here. You're going to hear application and application allotment heard, and that's a process at the very start where people apply for shares and then the business actually allots shares to them. We're going to look at first call and second call. It could be a third call, fourth call, fifth call, but once you get onto the calls, the process and the accounting is very straightforward, and they're all the same. Advantages of doing this, well, first of all, particularly when governments have been floating companies that they've owned, it's been quite common to do because they've looked to increase the amount of share ownership in the general population because they felt that would increase the stake that people had in a business. And both to companies and to the governments, doing a sort of staggered payment plan that increases the number of potential investors because people might not have £6,000 or dollars to invest straight up, but they might be quite happy over 2 years to invest that $6,000 in maybe 3 tranches of $2,000 each. Businesses can match the inflow of the funds to the actual business requirement. Shareholders can enjoy the benefit of ownership before they pay the full cost. So you are a shareholder when you pay the first £2,000 for the shares, even though you've got to pay up to £6,000 in the future. Disadvantages: accounting is relatively complicated. Companies have to chase investors for funds. They might not have the money due on the instalments when the company calls it or demands it. And there are penalties in there for investors that are automatically built in. So, for example, if you don't pay a call, then you not only forfeit the shares, but all the money that you've already paid in. And obviously, short term, it's not as good for cash flow. In terms of cash flow, if you're selling somebody £6,000 or dollars worth of shares, I'd far rather have the money tomorrow than have it in 3 years' time. Okay, we're going to look through an example here. And we'll do a slightly different version of it at the end. But here, the top bit is pretty straightforward. We've got $14,001 ordinary shares. They have a value of $14,000. They've got some money in the share premium. They've got some money in the retained earning capital accounts. Okay, they're going to issue 20,000 ordinary shares at a premium of $1.50. So that means the shares are actually going to be sold for $2.50. An application should be received from investors by the 15th of April. What that means, if you want to apply for a share by the 15th of April, you will also include the money in there, normally in the form of a cheque for the shares that you have applied for. So if I wanted 10 shares, at application, I would fill in the form, apply for the shares, and I would include, in this case, a cheque for $5. Then we've got a payment due on allotment. So after the 15th of April, in this case, the business is going to return funds to unsuccessful applicants if the number of applications is above 20,000. And in this case, it is because we know that 30,000 shares were applied for by individuals. And then they would send a letter out to people telling them they've been allotted with a set amount of shares and that they have to now pay $1 for every share they have been allotted by the 31st of May. And in the case of this business, they're then going to do a first call on the 31st of August. That means for every share that you've been allotted, if you've been allotted 10 shares on the 31st of August, you'd have to pay them $5, and similarly on the 31st of December. So running through it again, if I applied for 10 shares, I would send a $5 cheque when I first applied for the shares. I would then have to pay another $10 on the 31st of May, I would then have to pay another $5 on the 31st of August and another $5 on the 31st of December. And in this case, the business is going to return money to unsuccessful applicants. And it does this on the 20th of April. There's two options for a business here. One is they can just say, well, you are going to get the shares and you are not going to get the shares. And if you don't get the shares, you get your money back. The other one that's quite common, and we'll have a very quick look at that at the end, is where they pro-rata the shares. So if they pro-rata the shares in this case, where we've got 10,000 more applicants than the 20,000 shares we intend to sell, then what you would do, you would get 2 shares for every 3 that you've applied for. So if I'd applied for 30 shares, I'd only get 20. Okay, this is a complicated one. The call accounting is very, very easy, so there's no issue with that. And that's application and allotment. So we'd open up something called an application and allotment account, and it's just straightforward double entry though, what we're going to do in there. So on the 30th of April, we've received applications for 30,000 shares with checks. So the amount of money received would be the 30,000 shares that have been applied for, times them by $half, and that means there'll be 15,000 received in the bank account. That'll be a debit in the bank account, so it needs to be a credit in the application allotment account. And then we know that on the 20th of April, they're going to return any money to people that have applied for shares and not being granted them. So they received an application for 30,000 shares. They're only going to issue 20,000. So 10,000 lots of 50 cents or $half are going to be returned, which is 5,000. That would be a credit in the business bank account, and therefore it's a debit in the application and allotment account. And then on the 31st of May, people have paid us for $1 per share that's been allotted to them. There were 20,000 shares allotted, times that by 1, we've got 20,000 that was received in the bank. So we debit the bank account for 20,000 and we would credit the application and allotment account. And then to close down this account, we need to look at this little bit over here, the ordinary shares and the share premium. Well, the ordinary share account will get 20,000 lots of the nominal value, which is $1. So we need to credit the ordinary share account for $20,000 because that's a form of capital. And the share premium amount will be the money received, which was $30,000 in total. We received $15,000 and $20,000, but paid back $5,000. And then we subtract from that the amount that we've put into the ordinary share account, which is 20,000. So there's $10,000 left over that needs to be credited in the ledger account for the share premium, and therefore we debit the application and allotment account. And what you'll notice here, if we've done it all correctly, and the debit and the credit sides are equal, there shouldn't be a balance carried forward or a balance brought forward on an application and allotment account. Okay, looking at the calls are very, very easy because we literally just credit the bank, debit the bank when the money's been received, and it's all been received by the due date. It's a bit more complicated if you get shares being paid for late. So it would be a debit entry in the bank, there'd be a credit entry in the first call account, and then in this case, because the ordinary share capital has already been fully recorded in the ledger account for ordinary share capital, all that 10,000 is going to be credited into share premium. And if we look on here for the second call, apart from the dates being the same, everything is identical to what we did on the first call. But again, the key thing is the account should balance. Right, very, very briefly, we'll look at what happens if a company is going to allot the shares in a pro rata basis. So nothing's changed up here, and the amount that goes to the ordinary shares and the share capital doesn't change. Okay, we receive the 15,000 in the bank. But what we need to do when we're calculating the amount that's going to be received on the allotment of the shares, So the amount that's going to be received on the 31st of May, well, we know that we need, or we should have been receiving 20,000 on the 31st of May, because they should have been paying $1 per share for 20,000 shares. However, we received 15,000 in the bank on the 15th of April application, and we should have only received 10,000 because we should have received 20,000 shares multiplied by 0.5. So there's 5,000 too much gone into the bank on the 15th of April. So the amount we'll actually receive on the 31st of May will only be 15,000. Right, I think that just about covers off all the basics you need to know. And obviously, if you're one of my students, I will set you some work.